Today, we are putting two absolute giants of the specialty chemicals industry in the ring head-to-head. It's Cabot Corporation versus Orion S.A. We're going to break down their financials, their game plans, and their fight for the future. So, to really get what's at stake here, you have to appreciate the size of this arena. We're talking about the global carbon black market, a whopping $28.8 billion industry. And in that massive market, Cabot and Orion are true titans, together controlling almost a fifth of the whole pie. Make no mistake, these two are the leaders. But here's the real reason you should care. These aren't just some boring chemical companies. They are the hidden, absolutely critical engines powering our modern world. Seriously, the tires on that EV you've been eyeing, the coatings that protect our bridges, the batteries of tomorrow, all of it depends on what these two companies make. All right, here's our game plan for this deep dive. We'll kick things off by properly introducing these hidden engines. Then we'll throw them into a battle of the balance sheets, check their cash flow, and see who's really winning the race for green carbon. And finally, we'll look at their big bets and their big risks before we deliver the final HDIN Research verdict. So first up, let's meet the contenders. In one corner, you've got Cabot Corporation, this big, diversified powerhouse with its fingers and a lot of high-tech pies. And in the other corner, you have Orion, the laser-focused specialist, the master of all processed carbon black technology. Okay, time for round one, the battle of the balance sheets. This is where we really strip everything back and look at the raw financial health of each company. Let's see who's built on solid rock. And wow, right out of the gate, these numbers tell a pretty dramatic story. Cabot is more than twice the size of Orion in revenue, but just look at that profitability gap. Cabot's sporting a healthy 23% EBITDA margin and a really impressive 18.2% return on invested capital. Orion, well, not only is it less profitable, but it actually ended the year deep in the red. Let's just zoom in on that ROIC number because it is so important. It basically answers the question, how good are you at turning $1 into more dollars? And Cabot's operational excellence is on full display here. For every dollar they invest, they generate more than double the return that Orion does. That is a massive, massive advantage. So the big question is, how on earth does a company with $1.8 billion in revenue end up losing over $70 million bucks? This wasn't just a bad quarter. Something pretty significant had to have happened. So what's the story here? Well, the culprit is a huge accounting write-down, an $80.8 million goodwill impairment. Now, in simple terms, Orion basically had to admit that a part of its business just wasn't worth what they thought it was. And why? Because they're getting really nervous about cheap tire imports from Asia flooding the market and hammering their key customers. Okay, now let's talk about debt, because this is where the picture gets really, really clear. Think of Cabot as a sprinter, light, fast, agile, with a tiny debt load of just 1 times. Orion, on the other hand, is trying to run the same race while dragging a ball and chain with a leverage of 3.7 times. And that debt isn't just a number on a spreadsheet. It has very real, very painful consequences. Orion's interest payments shot up 26% last year, costing them over $62 million. That's money that could have gone into growth. Their hands are completely tied. Their loan agreements mean they can't even buy back their own stock. And worst of all, they've been forced to put a key plant expansion in Texas on ice. All right, moving on to our next section, cash flow and cost control. This is all about how well each company actually generates and manages the cash it needs to run and to grow. So is the tank full, or are we just running on fumes here? Let's quickly define free cash flow, or FCF. The easiest way to think about it is like your car's fuel efficiency. It's the pure cash that's left over after paying for everything you need to keep the business running. It's a true measure of how well the engine is performing. And the difference in fuel efficiency here is just stunning. Cabot generated a super strong $391 million in free cash flow. Orion? Just $54.8 million. But, and this is a huge but, you have to look at how Orion got that positive number. It wasn't from a strong business. It was mostly from a one-time gimmick of selling off their inventory. Now, both companies actually have a pretty clever system for dealing with the crazy price of oil, their main raw material. A big chunk of their sales contracts automatically pass price changes onto customers. But there's a catch. There's always a catch, right? There's a 2 to 3 month lag. This protects them over the long haul, but in the short term, it can cause some serious pain. And it's a big reason Orion's gross profit fell 16% last year. But this battle isn't just about today's spreadsheets. We're going to pivot now to the huge opportunities of tomorrow. It's time for round two, the race for green carbon. Let's see who's actually set up to win the future. Both companies know this is a big deal, but they're coming at it from totally different angles. Cabot is all about the product. They've launched this whole Evolve platform, a dedicated line of stuff made from renewable and recycled materials. Orion's strategy? It's much more about the money, using some really innovative financing to drive change. And Orion's approach is actually pretty fascinating. They have literally tied their loan interest rates directly to their ESG performance score. So a better score means they pay less in interest. It turns doing the right thing into direct financial savings. They've also invested in a French company called Alpha Carbone to make sure they have a steady supply of oil that's been made from recycled tires. Now for Section 5, Strategic Bets and Blind Spots. Here, we're going to look at where each company is putting its chips for the future and what massive risks they might be missing. And it really boils down to one simple question. Are they playing offense or are they playing defense? Is their strategy all about aggressive growth or is it about hunkering down and just trying to survive? You don't have to look very hard to see that Cabot is in full-on attack mode. They are pouring money into high-growth areas like battery materials for electric vehicles. They're expanding their global footprint with a huge expansion in Indonesia, and they're buying up a plant in Mexico to better serve North America. This is a company on offense. In Orion, well, they're pretty much forced to play defense. Their number one priority isn't growth. It's paying down that huge mountain of debt. We already saw how they had to put their Texas plant on hold. Their entire game plan right now is just about cutting costs and trying to run the business as efficiently as they can. But every strategy has a blind spot. For Cabot, it's one big word, China. A full quarter of their entire revenue comes from China, and that is a massive geopolitical risk. For Orion, the risk is different. Now that they've written off their goodwill, the next domino to fall could be their physical assets. Over $1 billion in plants and equipment are now at risk if the market doesn't turn around. Which brings us to our final section, the HDIN Research verdict. We've looked at the balance sheets, the strategies, the big risks. Now it's time to pull it all together for the final scorecard. So here's the whole story in a nutshell. The bull case for Cabot is pretty clear. They're financially strong, they get great returns, and they're a leader in the EV space. The bear case? That huge dependency on China. For Orion, the bull case is a potential turnaround story. If they can get that debt under control, there could be value there. But the bear case is that absolutely crushing debt, weak cash flow, and the risk that they'll have to write down even more of their assets. And so the HDIN verdict is in. In this 2025 Clash of the Titans, Cabot's superior financial health, its aggressive, forward-looking strategy, and its leadership in the markets of the future give it the clear, decisive edge. This whole rivalry, it really shines a light on a much bigger shift that's happening. 2025 is the ultimate test for this entire industry. It's just not about who can pump out the most volume anymore. The real winners will be the ones who lead the transition to a future that's driven by technology and sustainability. All the data in this analysis was provided by HDIN Research. If you want to see the full report and go even deeper, you can visit their website at hdnresearch.com. That's all for this deep dive. Thanks for watching.